Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan and here with Adrian Nicholson. Adrian, it's been a couple weeks. How has the summer been for you so far?
Summer's been great, Roshan. Been traveling a lot, just enjoying time with my family and friends. So that's always a great summer by my standpoint. How about you?
That sounds amazing. There, I don't think there's anything else you can ask for. I've had a similar summer. Spent some time traveling, time with friends and family. So I've been enjoying it so far. Let's dive right in. We have an interesting topic for today. Um, there's been a lot of market volatility recently. So we want to help break that down and then really address what you can do about it. So I think what we're breaking down is really what's going on now, and then what you can do about it. I would like to think can be timeless. For any time the market declines, it can be a similar process. So last week, we're recording this on August 8th. So on July 31st, the governor of the Bank of Japan made a comment that surprised investors. They had raised rates and then mentioned that they could see rates going higher than the 50 basis points or 0.5% that the markets expected. And that really threw the markets into a little bit of chaos for two reasons. One is a popular trade for this year has been betting against the yen. The Another popular trade this year has been borrowing money in Japan at low interest rates and then investing it in other countries where you can get a little bit of a higher rate. And if the yen then weakens, it helps you even more. Or even riskier, borrowing money in yen and then going and buying US stocks. So, a lot of tech stocks were going up this year, so putting money into something like that. And as soon as this announcement was made, the traders got fearful, had to close their positions out because the yen was starting to strengthen, which means they were losing money on the currency side of the transaction. And then they were unwinding any positions they could just to pay off their yen loans. That caused a lot of chaos in the market on really Thursday and Friday after the announcement. Well, then on Friday morning, so we had another piece of news that wasn't ideal. U.S. unemployment rate jumped to a 3-year high of 4.3%, and the unemployment rate had gone up from 4.1 in June. We were at a 5-decade low in April of 2023 of 3.4%, and everyone was then fearful of a recession. So you've got these two things that happened within a couple days of one another that threw the markets into chaos. And I know investors were getting concerned. Even going back before this happened, you had the S&P and the NASDAQ both down, and this was partly after this, but about 8% from mid-July. So investors are getting concerned with what's going on. So Adrian and I would like to discuss with you, what do you do about it, or how can you react? So Adrian, my first question to you is, with the two pieces of news or data that came in, the rate hike in Japan and the talks of more to come, and then the unemployment report, and those causing the markets to decline. What are your thoughts on that? Not only reactions to that, but how you think a prudent investor can or should react to that news?
Yeah, I'd be happy to, Roshan. So I'll start with Japan first, and that seems more of a isolated one-off instance where, it can happen again, but something like that, like you said, just caught people off guard. And what we know about investors is they don't like surprises, and something like that in Japan was a surprise. And two, that's also really a battle of big institutional investors versus retail investors, where you could see a day like Monday and what was going on in Japan causing a lot of volume, a lot of trading activities, which sometimes the big institutions do, which can really impact the market. So that's something too that you have to consider. So again, investors don't like surprises. We don't like uncertainty. And especially over Japan too, when you're talking about increasing interest rates where people are trying to capitalize on a low interest rate environment, that too can just be a recipe for disaster. So now I'll move on to unemployment, which is a bigger topic that I think we'll just discuss more and have to monitor more week in and week out. That, as we know, is one of the biggest things that the Federal Reserve looks like. They focus on price stability and full employment. So that's two very big things that they focus on. Where if you see unemployment goes up, that's a bad sign. People are out of work. That could show signs of a softening economy. The talks of a soft landing and a hard landing are that debate's going to pick up along with recession fears because as we know, unemployment going up, that's just a bad sign for the economy. So that's something that really just what I talked about before just causes uncertainty where a couple weeks ago everybody had was very optimistic, things look good, we got better data. Earnings still a mixed bag, but overall they have been good. Companies are raising their guidance. That's positive to see. But when you have something like unemployment go up, it makes you question and reevaluate and look at things, whether they're too good to be true or is this going to continue? And really, what people focus on, what is the Fed going to do? What do you think about that, Roshan?
Yeah, agreed. And fast forwarding to today, when we had another unemployment report come out, everything looked good, and all that volatility we had, a 5% swing in just a few days, we're within a percent of getting it back, right? Overall, from the overall market perspective. So I do agree with what you're saying. I think there was a little bit of investor overreaction. Bank of Japan walked back some of their statements as well. So, uh, with what you had said, first, it is definitely showing a difference between institutional and retail, right? You don't have many retail investors or individual investors that are going out there and borrowing money from Japan to invest elsewhere. So you are seeing the impact of that. It's one of those things where I can see if this was a continuing trend, people getting upset about it. And then with employment, um, the Fed doesn't have a percentage target with what is full employment, right? They haven't, I don't really define that. Whereas they had said for inflation, they want to get to 2%. So that being the case, not having a target, they did want unemployment to go up. Like the Fed has been saying that through this rate hike cycle that they a certain level of unemployment is, in their opinion, healthy for the market, so they didn't want to go up. It just went up faster than they thought, or than was projected for the 1 month, right? For that one report, because we're talking a week later with the next report coming out, and everything is sort of looking fine right now. The risk you said about recession is definitely a major concern. Let's spend a little bit of time talking about that. Do you have any thoughts, feelings, or opinions on recession risk and how that concern has been impacting the market?
Well, I would just describe it as the market and the economy is just still in a very sensitive state where you really just have to take it based on what data is coming out and just and monitoring that as much as you can because although we got bad unemployment, there's issues going on overseas. Overall, if you look for where we were at a year ago, things are getting better. For in fact, inflation's coming down. I talked about it earlier. Earnings are still strong. Companies are raising guidance, although that's not across the board. It's still trending in the right direction. Although when you get instances like unemployment going up, then that's where the fear kind of creeps back in and you can't really say, hey, that recession is just out the door. It could still be there. And that's why I think, it's the Fed's job to really look on it and really monitor it as much as they can because one of their biggest tools, which is something that people are looking at right now, is what do they do with interest rates? How much do they cut just to support if they see a weakening economy, unemployment going up? That's one of the tools that they can use, which they have been using to battle inflation.
Yeah, and I agree with what you said. I'll add on a couple things just to, and I'm not necessarily taking the stance that we're not or we are going to have a recession. I'm not taking a stance on either side. It's more about preparing for it if there is one, right? Just being cautious in general. And a few things you'd mentioned that I want to go back to is, unemployment is slowing, but the Fed wanted that. Um, you'd mentioned corporate earnings; they are by and large doing well, right? We are getting some good surprises, some upticks there. Valuations for stocks outside of tech, they really aren't ridiculously high, right? So that's another thing. Just when you're looking at it from a market perspective, the consumer is still spending, so we haven't seen huge cracks in that space yet. GDP numbers have been looking good and getting positive surprises. That's another thing. Just addressing the recession, and corporations have been preparing for a recession for 2 years. So you saw 2 years ago a lot of, primarily in the tech space, really, there was a lot of restructuring. They were having some downsizing or right sizing, whichever term you'd like to use in that space. You've seen it across the board with other companies. You've seen some industrials announcing that in the last few weeks and going through this. So I think corporations are making sure they're prepared, that they're lean. So overall, when that unemployment data comes in, and I'm not shocked a week later to see a better number in the markets recovering from the shocks of last week, I'm not surprised that we are where we are, where it has been recovering. I do think the fear of recessions are real, and um, there's nothing wrong with being cautious. At the same time, if there isn't, I wouldn't be surprised if there's no recession at all. So, and recessions happen, right? It's a part of the economy.
Yeah, and I'll add on that market volatility happens. These big swings that you're seeing in the
Yes.
market, like we had not too long ago, is something that investors, should be expecting because, as you know, depending on how your investments are structured. Some people say, hey, I didn't notice the volatility at all, but because that's how their investments or their portfolio structure. Whereas some people, let's just say people that are heavily invested in equities, and let's maybe just pick on the technology sector because that was impacted the most not too recently, experienced a lot of pain. So that's where you have to look at your situation and your portfolio as well. And if you hear things like unemployment's going up or fears of a recession or problems internationally, you really have to take those things and see, okay, how can that impact this part of my portfolio, or what part of my portfolio might do very well if this happens. And ultimately, what I really like to look at is a very long-term perspective where there's a lot of short-term noise, a lot of information, a lot of trying to pick what's going to happen. And that can be very difficult, where if you have to really expand your time horizon a lot, because again, when volatility happens, when we have these really bad days, that's where people come in saying, oh, you have to time the market, you got to find the lows and the highs, and that's where you can make money, which is very difficult to do.
Yeah, I would flip that, and I'd say that's where you can lose money. I'm sure. I'm not saying there aren't people that can do that. What I am saying is I don't know of any. I haven't met them. I haven't read about them. So I would I would really caution people from trying to trade based on just picking tops and bottoms on the market. Let's actually talk about that, Adrian. We talked about the cause. We talked about the cause of the most recent volatility. We talked about the recession risk. What do you do about volatility? I've got a few thoughts and ideas. I'm going to start with one though that is almost the opposite of the question I asked, and it's uh, I would almost argue that just the volatility alone should. Let me know your thoughts on this. If we're talking just because of volatility, I would argue that you don't do anything just because of volatility. And I'll continue on for other things you can do, but you'll notice there are other things involved. Now, seeing a 5% drop in just a few days feels terrible, but just that drop alone, nothing else going on, just that drop. I think if you built your portfolio and if the volatility is just volatility, there's nothing wrong with the holdings or the investment or your thesis hasn't changed. you really don't. I would argue you really don't do anything. What do you think of that approach or that opinion that just because volatility alone shouldn't be the cause of any changes?
Mhm. I guess it really just depends on the stage on how you created your portfolio or your investment. For example, I think this could be a good wake up call for some people where, let's just say you think you're positioned really well, you can handle the ups and downs of the market. And maybe one part of your portfolio grew exponentially over the last year. And then we have a day like we had recently, and then you see a big dip in the portfolio. And that's something that you feel like, oh, that's unacceptable. I can't handle that. How did that happen? That can make volatility in a way can wake up an investor and say, hey, what changes should I make on this part of my portfolio or my investments? Or if you're somebody on the opposite camp saying, hey, I expected this, that's fine. This investment or this part of my portfolio does that. That's what I knew about going into it. So I think that's part of it. And the other part too is what I talked about earlier about having a short term versus long term time horizon depending on how your portfolio is set up. If you have one part of your portfolio where that's the liquid part of your portfolio, that's something that you really need to consider in times of volatility, whether you keep it the same, you make adjustments, whatever it may be. Where if you have that long term aspect built into your portfolio, that's just something that you accept with the ups and downs in the market.
Yeah, and I can see you saying as a wake up call. That's actually what I've got second. I'm gonna echo a lot of what you had said, but I had said maybe you manage the volatility. My next thing after one being do nothing is you review your risk tolerance and whether you need to rebalance your portfolio. So once again, you had said the volatility can be a wake up call, not disagreeing with it, but I'm arguing that you're not making the change because of volatility alone. So
Mm-hmm,
you're
mm-hmm.
looking at it and you're saying maybe this volatility is outside of my risk tolerance. So I need to make an adjustment because of the risk tolerance. Once again, not because of the volatility being the wake up call. And then second, with rebalancing, just as a basic example, if you had your portfolio at the beginning of the year at 60% in stocks, 40% in bonds, actually, before I continue on that, I think it's a good time to say, to give our disclosure, this is not financial advice. Please consult with your advisor. We're here to help. If you'd like, you can reach out. You can reach out to us. This is just for discussion. It's our research analysis, things we'll tell you to look at. So, but getting back to my hypothetical, if you started out with a portfolio of 60% stocks and 40% bonds, if that's your target, and then stocks go up 20%, as they had been in that neighborhood in July this year, and your bonds didn't move, well, now you're actually at 67% in stocks and 33% in bonds. So you are a little bit out of alignment with your target portfolio. Maybe, as Adrian said, the volatility is your wake up call. You use that as an opportunity to look at your portfolio and rebalance, or look at your risk tolerance and confirm that this portfolio is in line with your risk, or if it's not, that's when you make adjustments. So going back to what I said earlier, the volatility, I like your terminology, Adrian, calling it a wake-up call. The volatility is a wake-up call, but the volatility is not the reason for the change. It's either your risk tolerance or your portfolio needing rebalance that could be the reason for the change.
Yeah, exactly. And just examining all the different components of it as well. Just using your 60/40 example, I think one focus that people are have to look out to, especially, is that fixed income portion as well, because one of the things that we're looking at is what the Federal Reserve is going to do with rates, and that has a very significant impact on fixed incomes like bonds. Depending on how you structure that, maybe last year or a couple of years ago or whatever you created your portfolio, that's also something that you have to also check annually just to see if you need to make any adjustments there. Where I said in the beginning, sometimes you have to block out all the short term noise, but you also just can't ignore it completely and just stay up to date as well, just to see if there's any opportunities out there for you to make strategic changes.
Yeah, I completely agree. I've got another one on my list that I'll go over that I think you can, using the volatility as a wake up call. I would say review the portfolio, right? And how this is different from risk tolerance and rebalancing. With risk tolerance, it's your comfort level of risk. With rebalancing, it's looking as your portfolio at its target. By reviewing your portfolio, I'm now saying review the components, and specifically the stocks and the bonds that you own. It's easier to go over with stocks, but if you own stocks and companies you believe in, or indexes or mutual funds that you believe in, and you're comfortable owning them through a decline, then you probably don't need to do anything. But if you're reviewing all those holdings and you're saying that you don't feel comfortable owning this company for whatever reason, it's too risky, it's you the thesis you had when you bought has changed, you don't believe in them going forward, or maybe it's just gone up a lot and you think the upside is limited. Whatever the reason is, this could be an opportunity to look at those holdings. And if you look at those and you don't think you'd feel comfortable holding it through a decline, I think you that may be uh, a reason to sell or to research further. But I think that's a good opportunity to just review the portfolio and the holdings that you've got.
Yeah, that's very important as well, like you said, because again, volatility can create opportunity, and that's something where people, the ups and downs in the market can feel like a roller coaster ride and cause a lot of emotion to some people. Some people it may not. But again, that's where it really has to show sometimes what type of an investor you are, where the next time it does happen, you could be more prepared.
Yeah, I completely agree. And that the last thing I have on here under my categories of managed volatility or how to manage volatility, you just use the perfect word. Is this a buying opportunity for you? When you look at your portfolio, the time frame, the risk tolerance, remember with rebalancing, you're typically selling things that have gone up and buying things that have gone down. As a the rebalance naturally causes you to sell high and buy low, so to speak. And but when you look at this, you look at your portfolio, you might think, I need to get rid of position A, whether it's a stock, bond, or whatever it have you, because I don't feel comfortable owning it through a decline. And maybe position B has gone down, and you're adding to position B, or maybe there's something new that you didn't view as a buying opportunity for whatever reason before, but might be now that the markets have pulled back. So those are the things I have, the four things that I would say when volatility happens in the markets. Use, as Adrian said, use it as a wake up call. And the four things that I've got on there is: one, don't do anything just because of volatility. Two, review your risk tolerance. And I'd actually call it five. So two is review your risk tolerance. Three is rebalance the portfolio if needed. Four would be review the holdings within the portfolio and to see, are you comfortable owning them through a decline if things are going to continue to pull back, and make changes as necessary. And then the last one, which is the fifth item, is it a buying opportunity, or are there things you'd want to buy now because of the volatility? Right, things have gone down more than you think they should, or you look at it as a place where you can buy. Um, what are your thoughts, Adrian? Or do you have things to either add or that you'd actually remove from the list?
No, I mean, I think it's a great list. Just added to our episodes, because our first couple episodes were about market volatility, which was 4 years ago, where we really do provide a lot of valuable information and tell you some things that you should do, should not do, focus on, and ultimately what's best for you. How can you still achieve your goals, and really focus on some of the principles and strategies that you have and built into place. And I think that's also something very important, because sometimes these are short-term moves that you really have to just deal with on a day-to-day basis. But ultimately, you just got to focus on your long-term picture.
Yeah, completely agree. Uh, I hope everyone found this helpful today. I think this is, as I said, the part on how to manage volatility. I think you can use that forever whenever you have this volatility in the markets. But we did want to explain what the cause was. Please reach out to us if you need help, or if you have questions or topic ideas that you'd like us to cover. We're definitely here to help. Like, subscribe, give us 5 stars. We'll be back with another great episode in a week of the Retirement Lifestyle Show. Take control and achieve your goals.
Schedule a conversation with Roshan, Adrian, or Eric today at retirementlifestyleshow.com. Roshan and Eric are certified financial planner practitioners. They, along with Adrian, are investment advisor representatives and serve clients across the U.S. with financial planning and investment advice through Arate Wealth. If you found this show helpful, gained knowledge, or enjoyed the time you spent with us, tell your friends and leave us a 5-star review. This will help others discover the show. To access our show notes, to download any of the tools mentioned in today's podcast, to ask us a question, or to schedule a conversation, go to retirementlifestyleshow.com. All opinions expressed by podcast hosts and guests are solely their own. While based on information they believe is reliable, neither Arate Wealth nor its affiliates warrants its completeness or accuracy, nor do their opinions reflect the opinion of Arate Wealth. This podcast is for general informational purposes only and should not be regarded as specific advice or recommendations for any individual. Before making any decisions, consult a professional. The show hosts offer investment advice through Arate Wealth Advisors, LLC, an SEC-registered investment advisor, and securities through Arate Wealth Management, LLC, member FINRA, SIPC, and NFA. Finally, our music is The Chance by Jason Shaw and Audionautics. It's part of the YouTube audio library, and it's licensed under a Creative Commons license. I am Ray Voices. Thank you for listening.